All right, so let's get started. So thanks for joining us. Today we're going to be talking about investing in values. Primarily, this one's focusing on ESG, which is environmentally, socially conscious and governance. So whether that be like social corporate governance, etc. That's the main focus, but you'll see a lot of what we have in here, and we as a company also try to empower people uh, per all of their values. So we actually have strategies for halal, so that's Muslim faith-based, Christian, which we break into Protestant and Catholic. But again, I'm focusing a little bit more on the ESG, primarily just because there's like these culture wars and the backlash on DEI and all this stuff, and so it's tough to talk about, and there's big targets out there on people if you want to vocalize on it. And I definitely think things should be stood up for. But there are a lot of people that would like to make a difference without necessarily having to take the negativity. So that's kind of our things. If you're on here, you probably still care. And, absolutely we do. I've been building this and it's been a core value of ours pretty much since we started. And now we're getting a little bit more economy of scale. This past year, I started a financial technology company, and we're building some of our own things, which are pretty cool, I think, to enable people values-based and more egalitarian-based. So let me go ahead and share a screen so you don't just have to see me, and we'll get going. Okay, so hopefully you can see my screen here. I shared with you in the chat channel the slide deck, something new. Oh, cool. Jade's from the UK. Thanks that's awesome. If you want to share where you're from, that's terrific. I love the interactivity because these things are live. I build all of these webinars custom, and they're usually pretty up to date, so that this shouldn't be any kind of cookie cutter things you've heard before, even though obviously no one can be 100% unique. We're all a community learning, building upon one another. So let's drive. So, why are we here today? So I think this has been around and it's been fabulous the last 20 some years. I have been an advisor in helping people with their financial planning and investing. That ESG has gone from some little niche corner of some, curiosity that was expensive and hard to do, et cetera, to being like this huge industry, and in really a large amount of assets. There are a lot more people than most people would believe that are doing this. And now that it's actually making a difference, it is actually starting to change some of the governance of companies and how we're doing things in the world. I think that's why you're seeing this big backlash, because some people are like laissez-faire, profit maximization, only type of people, and they see it as a threat, or they just, I don't know, just don't like people. There's always been a history, I think, of human beings persecuting others that don't believe the same way as them, even though I think a lot more people that are ESG, as long as they're not hurting other people or the environment or, are more of a live and let live type group of people. So, if there are questions, feel free to put them in the chat, and I'll try to hit them as we go. Try to keep it to subject matter as well. But I want to go over some of this, what's going on, empowering people to still be able to pursue this, maybe even elevate it and do better. As well as one of the things that I've noticed over time is that it was an expensive niche kind of investing side thing, and the costs have just come down, and the access has gone up. We've gotten now to where, with some of the enhancements we're making, we've gotten the cost down almost to parity with non-values-based investing, which I think is just terrific. Why slide going? If it will go. There we go. So I think, beyond what is in the headlines and the media and what certain talking heads would have you believe, I think the majority of Americans and our Western friends still believe in a lot of these things to a majority. 73% expect, companies should protect the environment, and 81%, expect companies that should demonstrate corporate citizenship, whether that be taking care of community or country or their employees, and not just profit maximizing. And then, 70% of people wish they could invest in companies that aligned with their personal values, right? And so, despite all the noise that's out there, surveys, when people just get to tell, more anonymously what they feel about, I think is a little bit different than the mainstream would have you believe, or the talking heads. So, a little bit about, who we are, Rebel Financial, because I think it's important, and you can look us up as well too. We very much started as a values-based company. That's kind of why we have a weird name. There's multiple reasons why we're Rebel. I actually did a whole other webinar last year, helping people to understand that. But we believe in stewardship. We're a certified B Corp. Actually, not too long ago, we got finished recertifying again. We raised our score again. So B corporations, you're basically putting yourself through the ringer to show that, hey, this is what we're doing to minimize our environmental impact, or the good things that we're doing, how we're taking care of our employees and our community. And there's a ton of different things. It takes a long time to go through and prove, and then they score you. So you got to be at least 80 to get in and be certified. I think the average score, in the United States is a little over 50. We pushed our score up to 104. I think our first score when we did it back in 22 was like 96.8. So, it's a marathon. You got to keep improving, not just be there. So we're veteran owned. I'm a veteran. My wife's veteran. And we really do believe in empowering people per their own values. So we're one of the few shops in the country that even do Muslim faith-based, or that halal that I was telling you about. Not because I'm personally Muslim, but I do think the vast majority of human beings are good people, and they're not empowered. Or a lot of what's happening is people are incentivizing their better devils instead of their better angels, right? And so our goal is to help people be able to express that. And the more people that we can do that, I think the world will be a better place, regardless of what their specific tenets and what so are. So you can check us out there. I'll put QR codes through here. If you're on the slides that I put the link to, like when you're on here, they're clickable as well too. So you can check that out. So I really do think it is a problem. It's unfortunate right now how politicians are politicizing everything, right? I thought this was a good quote by Huxley. Obviously wrote Brave New World. It says, beware of being too rational in a country of the insane. The integrated man, or the most logical, rational one, doesn't become king. He gets lynched. And I think that's exactly what's happening now. I mean, if you speak out, if you're about good things that make sense, not just because you want to hug trees or anything, but you think it's the right thing to do and it's going to make a better world. And who knows, in 20 or 30 years, we may make more money doing the right thing than the wrong thing, right? So you are getting the backlash, right? Mainly for short-term political expediency of human stereotypes and lots of reasons for the not nice things about us as human beings. But it is counter. It's counter to what you think would happen. That the people trying to do well for other people and being good stewards of the world that they live in and for the next generations and stuff, it seems very counterintuitive that you would be the one to be targeted, or the people empowering you to be able to do that would be the ones to be targeted for the backlash or the persecution, etc. And you're seeing that a lot, whether that be, fund companies or investment managers, or community organizations, university DEI programs, etc. It's rather sad, in my opinion. But hopefully, the pendulum and will swing back. But still, what we're here to talk about is for you. What can you do, right? We can't solve society's problems. We can't, change every person's biases and incorrect things that they believe that hurt others. We can only work as hard as we can to make the world a better place with the power that we have, and you do have that power as you accumulate wealth to take care of yourself and your family and the things that you care about. And so, a lot of the stuff in the past, because for the last 20 years, I think until the last 4 or so years, ESG and what's own. Before that, it was socially conscious investing, or socially responsible investing. You see, SRI used to be the predecessor to ESG. Really just kept gaining traction. And then when people invested that way, it was more expensive. It was perceived as riskier. And so you could tell your peers that were kind of like-minded, and they were like, wow, you really do that? That's admirable, et cetera. And so I think it really grew from this, you could market, and hopefully most people weren't doing that. They really believed in it. But fund companies and investment managers and the investment world in general said, oh, we can grow by taking advantage of this trend, and people want this, and they want these labels. They want to advertise that they're doing good, that they're putting their money where their mouth is, right? And so now that environment is turned around, that's almost exactly the opposite. It's like, it's a vulnerability. You're a target, right? Now, I haven't seen too much individuals getting targeted, but still, it's possible, right? I think it's more the companies and the funds and the idea more than anything. But again, that does make less choice. And if the regulatory environment makes it to where it's like, oh, well, you're not being a good fiduciary because your fund is promoting environmentalism and good governance, you didn't vote for this thing that the company would have made way more money in the short term. We think your investors should be able to sue you, right? And so it creates a problem, right? And so in that respect, it's really going to cut down the efficacy and even the want, I think, of people to want to do this as much. So, with us, our belief in this is that, investing should quietly and authentically. If you want to advertise it to the world, fine. I mean, we advertise it. I'm not afraid of people. That's why we're Rebel Financial. They try to come after us, but we're kind of a small fry. We're a small fish in a big pond. So I don't think anybody is out headhunting for us. But quietly and authentically, not performatively. And what I mean, it's got a duality when you hear about it. It's like, oh, so you don't care about performance. Absolutely, we care about performance, like rate of return performance. But when I use performatively this way, it's like, we're not performing. We're not making these portfolios so people can brag about them, or that we can brag that we do values-based stuff, right? It shouldn't be a marketing tool. And unfortunately, I think when you see a lot of especially larger companies, the banking companies, the insurance companies, they're doing their commercials and their billboards, they're usually doing one of two things. One of them I'm totally on board with and I like, which is appealing to humor. They've got big banks that can make some really funny commercials, et cetera. That's great. The other one is almost like faking that they care about things when it works for their PR moments, right? They're looking for that spotlight instead of like a really being genuine, that they are always doing this. It really matters to them, and that's why they do it, not to get a sales boost or a polish on their PR after they did something bad and ripped a bunch of investors off by being racist with their mortgage applications or whatever the case, right? So anyways, that is where we think things should be. And again, since we empower people to do what they believe in, then we don't have a cookie cutter type thing that's easy to advertise. But that is the fund problem right now. So like, if you want to do this, then generally how most people will do it is, if you're kind of DIY or investor just doing it, direct consumer, you're going to find a mutual fund, that's what we say, fund, or an ETF, which is another type of fund. And then that manager inside of there is going to invest. And then generally, depending on what type of fund it is, you're going to be put in a kind of a bucket that's generalizing certain values things in there that they're going to try to do for you. So, there's only so many of these different permutations of buckets that you can make, because part of it, when you're going to spend a ton of money to make a product like that, is you get economy of scale the more you get in there. So you don't want to break it up too finely into all these crazy different buckets. You want to have one big bucket that appeals to the most people, and that's how you're going to optimize how much you make. And so this is what you're getting. And generally, when you get different ones, it's because different fund companies or managers are competing against each other. Some of them specialize. Probably one of my favorite ones that does a better job is Calvert funds. that they will make more than just, a couple three, or what, so that you have more choice or can build a portfolio out of them. But still, even in that, it's going to still be kind of cookie cutter. And then, because that's their business, their main business is more money getting into the fund, then they're very markety, right? They gotta like get out there and sell the fund. And this is, in my opinion, a very legitimate gripe on our industry on this side of it. They call it greenwashing. So it is like making things sound better than what they actually do, for whatever their purpose is, whether it be, emissions or environmental activism or carbon free or, gender equality, or there's all kinds of different issues, and some of them try to put everything into one, but still they don't necessarily they got to sell it. They got to juice it up. Now they got to be careful that they don't get in trouble with the regulators that they're lying, but they're definitely a lot of times overselling and under delivering in terms of the actions that they're taking on the principles. And so I put this down here: pop values only. You can see me. I love to make AI pictures, so you can see there's a pop ESG concert and all these people getting put into big human buckets. So I like that. But again, you're gonna get popped out on your ESG basically on the things that are popular of the day. And who knows, that may evolve over time. It absolutely has evolved since I've been doing this, which with the growth of that niche has been fairly good in terms of driving down prices and bringing more players into the game. But still, you are going to get, into those buckets that we talked about. And so what are the conflicts of interest? Anytime you do anything investment wise, this is the main thing, our conflicts of interest. Every investment player pretty much has some conflict of interest. And the real thing is, hopefully, if you're a fiduciary like we are, it means you have to put the interest of your clients before your own, then you're trying to reduce them, right? And you try and get rid of them as much as possible. You can't get rid of all of them. And so then when you're left with the ones you got left, then you got to disclose and help people make a good informed decision at the end once you reach it and everybody understands. And so again, we already touched on the first one, which is that marketing thing, right? They need more volume. They need to get the word out there, and they want to sell what they have. And this, absolutely, as I said there, it's a great concept to sell. But are they actually doing what they're promised? And this is what it comes down to. They're trying to asset gather and fee maximize. Okay, so almost every investment manager out there, if they're very successful, primarily is doing this. They're trying to get more, we call it AUM, assets under management. They're trying to get more AUM. They're trying to lower their costs. They're trying to raise their fee as much as possible to make more money. They're for profit. And most financial companies that are for profit these days are profit maximizers. That's why I call them profit maximizers. And totally, transparently, we're for profit as well too, but we're a B Corp. And the one thing that I believe in is non-laissez-faire capitalism. And what I mean is that I believe that other stakeholders should stand in front of shareholders. So absolutely, if you are an entrepreneur and you start a business, I absolutely think you should be able to make money and a profit, but you shouldn't do it at any other stakeholder's expense. And to me, that's the exact opposite of what I call profit maximizers. And profit maximizers, I think, are most businesses in the Western world. And of course, the United States is the most guilty of this. And I think this is where a lot of our problem stems from, is that we have that MBA, the Master's in Business Administration philosophy now just soaked into our world, that all these people have graduated and gotten in charge of things that just believe their sole purpose in life is to make the most profit for whoever their shareholders are. And by econ standards, that is efficient. But what kind of world are you going to make with that? And so even these funds that are, ESG, they're generally for-profit businesses that are still profit maximizing. And I argue that I believe that if your primary objective is profit maximization, if that is your driver for being a values-based strategist and investor, that's a misalignment. Why are we hiring someone like that? Because it's real easy to lose sight of what you're trying to do. So you can get half-hearted advocacy and little to no shareholder activism, especially because a lot of people are trying to solve for how can we invest in these companies that look good, are doing the right things right now, but we don't want to get sued. So we're not going to like try to change people or vote for things that are against what the board recommended. And what's the board doing? They're profit maximizing, right? So again, it's not like we're against profits. Like we can vote for things that would be profitable or that enhance a company that have other objectives as well too, right? So I do think you get watered down impact. I think this is why you see CEOs and boards paid extraordinary amounts of money in the United States, et cetera, because even though you might be in a fund that's values based, nobody's voting the proxies well, and we own them. We own all these companies. And so there's more and more companies going private. That's true. But we can even buy them in private equity. I hope to eventually see legislation that requires private companies that have broad-based ownership from shareholders to follow the same rules as publicly traded companies and put power back to the people. If they want to raise money from us and they're letting most people invest in them, they should have to follow the same rules, right? So this brings us, this picture kind of zoomed in, but it's really like a billboard on a street. Like with this nice green thing, but if you rip it open, it's just like money behind it. Another one of my good AI pictures. So I think, this is what I started with, performative. They're out there performing as convincing you that you're changing the world and that you're investing per your values. But it's kind of a marketing trap. What change are you really making in the world? I mean, I commend you that you're doing it if you're doing it, by all means. It is making a difference, but I think it's a lot less than you think. Okay, so it's kind of like they market good, they tell a good story, you got good names of funds inside of there, and absolutely, this is how I've implemented for the longest time because I didn't have a choice as an advisor or kind of like sub advisor, right? Because we hire the funds or the ETFs for our clients. Now we're building our own portfolios of individual securities, being able to get away from this performative approach more. Okay. So when we look at this, I believe these things. So stewardship, regardless if our clients want to invest per their values or they do traditional, we call it traditional. When somebody's like, all right, I want you to just find me, the best value, the best companies that you can to make me the best rate of return. That's our traditional. So regardless of if it's ESG or halal or Protestant or Catholic or traditional, stewardship is very important to us because, people spend their whole lifetimes, saving their money and building it up. And so much of our financial and insurance and banking industry is just built upon almost like car salesmen. It's like buyer beware. And not that there aren't wonderful people that are car salesmen and insurance people and bankers, etc. But really, let's be honest. You walk into your local bank, how confident would you be that they're going to go out and search for you the best product for the lowest price, or give you the best interest rate, or give you the best life insurance for your family for the lowest price if you don't shop? I mean, it's getting pretty close to zero. Same probability that that's going to happen, regardless if that's a good banker there, or insurance person, et cetera, right? But we believe in that. We're always a fiduciary to our clients. We are going to do what's right for our clients, even if we make less money, give them the alternatives, spend extra time to shop for them, and disclose everything that we can. So even if they don't pick the cheapest or the one that we think that there's the best, they are able to make an informed decision. And if you get busy with life or your family, you can feel absolutely good that we'll take care of things for you if you're busy, right? Authenticity. So we don't want to greenwash things, as I was explaining earlier. We want to do things because we believe in them or our clients believe in them, and we're empowering them to make them happen for them. And then we try to build it in a way that people can understand and it's transparent. And integrity. I mean, like, people lose sight that one of the main reasons that the Western world, especially the United States, in terms of its financial markets and what's so And of course, we have glaring exceptions. But one of the main reasons that it works is because people feel comfortable enough to trust each other to do business or to trust the system, even when they don't trust each other. Now, there may be middlemen that charge fees and blah, blah, blah to add that. But there has to be trust in a financial system where you're willing to risk a lot of what you have to build and grow more to the future, usually by letting someone else use your resources to build and do, right? That's a lot of trust. And so, there's got to be those of us in the system that are injecting more and more integrity, because I do think if all you're doing is profit maximization, a lot of the people lose sight of this. And a handshake means something. And when you say you're going to do something, you always do it, regardless if you have to or not, or if you lose money, etc. And so we believe in this. And then alignment. Again, I believe in empowering other people to do good. And I think that will multiply over time. And we're building some of these things to help people be able to do it. So what are we getting down to? And the irony of this is, a long time ago, before there were mutual funds, most people bought individual stocks, right? Or they put their money in a bank. Some people that had more money bought bonds, right? And so what ended up happening is they made mutual funds and say, hey, listen, it's hard to put your own stock portfolios together. It's expensive. There's a lot of trading. Brokers, et cetera, tend to rip people off that are smaller investors. Why don't you just invest through us and we'll buy you a big bunch of stocks and put it together for you in a package, right? And mutual funds really took off. And then over the last 15 or 20 years, ETFs have started to kind of take over from that, but really same concept. And now what we're proposing is, with technological advancements and trading costs going down considerably, the asymmetry of information in terms of what the insiders on Wall Street know versus what you're capable of knowing has more equalized. Not that everybody's going to take advantage of that. Most people will probably hire someone like us to get in and protect you still from that asymmetry of information. And now they're making fractional shares. So fractional shares, Robinhood's probably the most popular example, being able to buy $1 worth of, a stock, even if that stock was $1,000 a share, right? You can buy $1. So you're buying a fraction of that. You couldn't do that. If you couldn't afford one share before, you cannot buy that stock, right? And so it was very difficult to make an individual security portfolio because, you at least need 30 or 40 stocks in there to kind of take out some of the concentration risk of an individual thing kind of sinking your ship. You want your eggs in different baskets, right? And, with our portfolios that we build, we call them plank portfolios, but I'll show you that. We generally have about 240 inside of there, out of the tens of thousands that we could invest in. But that really gives you good diversification. But that'd be very difficult to do, sub $250,000 worth of account if we could not buy fractional shares. And so when you do this, though, and you have all these different stocks inside of there, almost anyone, unless they're very talented investment wise or have some sophisticated tools to break down your portfolio and you actually shared it with them, they would not even know that you are ESG or halal or whatever the case. And so there's no controversy. There's no whatever, either to you or to the cookie cutter bucket you're in, because it doesn't have to exist anymore. And so this is the thing that we like leveraging technology, is we can have custom construction. So every one of our clients' portfolios is unique to them and what they believe. Okay, I got a question here. It says, how do we pitch to investors while not being open to being acquired? We want to offer revenue share rather than a plan to exit. So, Jade, that is more of a, it's kind of totally different than what I'm talking about right now. You absolutely can do that. And fortunately for you, there's tons of private investors out there, whether they be VC or angel investors or private equity, et cetera. Of course, if you want to find the nicer side of things, or someone that's not trying to take you over and get control or find a quick exit, then you're going to be looking for individual angel investors that just have lots of money that may be trying to do something like what we're talking about here, which is make some money and continue to grow their money, but they're trying to make the world a better place as well too. And so that's hard, and it takes a little bit of research on you. If you get more well known, some of them may try to headhunt you. There are almost like agents. Again, I'm not as familiar with the UK landscape as much as the United States, but you fortunately live in a good time for what you're doing, in terms of there's very concentrated wealth in certain places that absolutely has more money than they have homes to invest it and continue it to grow. So while it is work, you should have lots of opportunities. Okay, so Planck portfolios. So I mentioned, so Planck's constant is a common physics term, and I don't want to bore you all. I don't want to bore you all with getting into physics or what so, but it really comes down to like the smallest energy for like quantum physics and what so. And so for us, we were trying to build really egalitarian portfolios so we could bring to smaller investors like sophisticated, nice investing. And in our industry, there's a terminology called direct indexing, where it's kind of like you're making your own index funds, right, by getting these. So for us, we're not against indexing. We like indexing. We also like active management. But for us, I like the name. I'm kind of a science nerd and what so, and I don't think people got to totally understand it. But that is why it's called Planck portfolios. We hope people just know Planck, even if they don't understand why it's named that eventually. And so what we're doing is we're building custom strategies that avoid any overt ESG or religious or however you believe labeling, but is built for you to be resilient, to reduce the impact of performing way different than how the markets do, hopefully making more of a positive change. And then especially you own the individual stocks, so you can actually vote them as well too. So not only giving access to capital to people that are doing well, but we can vote the proxies and actually change some things. We may make different things in the future to where we'll do more impact and advocacy versus screening and what so as well too. That would be exciting and cool to me. Got another question here from Franklin. ESG can encompass the Magnificent Seven, which may pass certain requirements to be ESG, but may not be values aligned. How do you screen based on values? How do you avoid computation risk? So first of all, we do that by a matter of, even our regular traditional portfolios for our clients that aren't opting into Planck, they're still using like our ETF, mutual fund portfolios, et cetera. Our large cap exposure is probably 30% to 80% less than the average investor, just because we don't want to be mega cap heavy. I think that's way overvalued. Now, do we have exposure? Absolutely. You can't just like take things out or you get into what's called market timing. And we don't like that. We want to provide consistent good returns to our client. I mean, even if you look at this year, the S&P is only up, 10 to 11%, and our international, it's just a bucket. Our international bucket is up like 23 or 24, right? So we put our eggs in different baskets and we want to buy low and sell high. So recently we have been taking profits the last few years from those, and then we weight lower on that market cap anyways. It is possible for us to do that since we build custom. We generally don't like to totally screen out things just because they're in the top 7 or Magnificent 7 or what so. They are going to have a whole lot less exposure than most people would have. I mean, a lot less exposure, and we've still performed very well regardless of that. But I don't see, if somebody is like, I hate Google or I hate Tesla, I want zero of that. We could absolutely do all of our screens where we're building the individual portfolio and make that an exclusion. We don't like doing things like that because things change, companies change. They could be a good actor now and then do some things to become a bad actor, right? And we would screen them out. And then if they come back and the board changes some things and fires this person and does this and they're doing great things again, boom, these are the types of things we want to do to change behavior, right? So anyways, I hope I answered that question. Obviously, I can't go all the way down into it, but absolutely, if you're going to build custom things, then you can do things like that. But again, it's sometimes a conversation with our client or the investor to say, okay, I see why you're here. Let me explain to you some of the repercussions after we talk about this. Is that still, what you want? Right? They're like, yes. Or they're like, no, I never thought about it like that. Then good. That's what we're here for. Okay. So obviously, I think it is very sad that there should be any kind of stigma with this stuff at all. Even people that don't want to do it. I got one client that's like, Phil, you got anti-ESG. I want to pump as much oil. I want to do this. I want to do that. I was like, all right, man, that's not like what I do or what I believe. We could build something like that, but let's just be traditional, right? Traditional just means we're going to try to pick the best companies for the best price to try to optimize return. It's like, yeah, I guess that's right. It's like, we don't need to be like devil's advocate, doing overtly anti-ESG things. But anyways, that could be stigmatizing. But why can't we express our values without labels, without anybody knowing? If you want to advertise it, you could. And then in the end, we actually have more impact. We can make a better change. And then this puts no bullseyes on anybody. It's hard to fight somebody if you can't find them. You're swinging at somebody that's not there, and you're rope-a-doped, right? As Muhammad Ali would say. And let's make real world change. And I think it is an upgrade in multiple levels for this, because we actually want to do good and make the world a better place, not just look like we are. So resilience against backlash works for you. It works for us. It'll work for any managers or other partners we work for. Is like, let's make a really awesome strategy that there's no bullseyes, and then empower people. I mean, who wants to be in a bucket, right? Are you in a bucket with 200,000 other people, 2 million people that are just like you? That doesn't sound great. I mean, it's good that we're together and it's okay, but you're unique. You are. And it is interesting to us as we've built this, that everyone's is unique when we build it, even though there may be similarities in what's out, and it can evolve over time. But remember, I think this is one of the biggest things that I've had in overcoming objections and getting people to invest per their values, is they're like, well, if I do this, then I just have to get lower returns. That is not necessarily the case. Like I said, you could end up with higher returns. And I think for the last couple administrations, you did get higher returns. Then in this presidency, and with the backlash, ESG's taken a hit. But I don't necessarily think it would if they didn't have the actual like targets to go after, that ESG or green or whatever is in the name of it, right? And from that perspective, I still know, when I look at my clients that have been doing this for like, say, 12 years or so, even with us underperforming a little bit the last some years, there's still a good bit ahead when we look at like the decade or what their net rate of return was. And when they started, some of the ESG strategies were almost, 1% per year more than the non-ESG. It was expensive. Now it's come down almost to parity on cost, and there has been fee compression in the industry. So the average fund that used to charge 1% or 1.2% now may be down at like 0.3 or 4% for a mutual fund, and maybe like 0.25% for an ETF. And if you go really low cost on the ETFs, you can get down to 0.01 or 0.05 inside of there as well too. So that's great. And then of course, all these things that are in there, I'm not just going to read you my slides. I think you get the point of the fact that we just don't necessarily need to advertise it. It's not going to help us do better. It's not going to help you. If you wanted to tell people that you had it, you absolutely still can, right? So proxy power, this is a big belief of mine. Actually, one of the fintech things that we're building is called Proxy Vote, and we're kind of trying to use AI so that our AI can understand what you believe in, and then it votes the proxies for you. It actually goes and reads through all those big books and stuff that they send you that almost every investor just throws in the trash. And so no wonder our CEOs and boards are just going rampant and doing whatever the hell they want, is because anybody that has the individual stocks is not holding them accountable and voting per what they believe. And number two, most people are delegating all of this voting per mutual funds and ETFs, and they don't want to get sued. So they just do whatever the board tells them to vote whatever they recommend. So they can do whatever they want. and the owners are not at home. If we own the stocks, plus we're implementing this thing, a lot of fund companies, or even when they don't want to vote the proxies for you because they are afraid you're going to sue them. But if we can make AI pull the work for you automatically, do all the work to actually submit your votes, but you sign something that says, yes, that is how I believe. If it does the work and votes that way, I say that I've delegated my research and voting to this. It's what I decided. Even if you put it in for me, you're only helping me. I still take responsibility for it. Then we can empower people to vote themselves. We can get rid of, hopefully, because I don't want to get sued, we can get rid of the litigation, and we can actually do right and have accountability for what you believe, you know? So I think this is a huge thing. I think this is going to double like the power of values-based investing. And then you own the individual securities, so you're not just outsourcing it to BlackRock or Vanguard or Fidelity, who may not be bad companies, but again, they're not going to get sued for you, right? And that's probably not what you believe either, you know? So I think this is a big thing. I try to tell people in my industry. I was just at a conference speaking in DC just last week, and it's funny to me, like certain investment advisors that deal directly with clients like you guys are like, that's so awesome. But most people in the financial industry, they're like, who cares? Like they just don't even see it, the value. But I think individual people, if it doesn't cause them a lot of work, I think it's going to resonate a ton. And if more and more people do it, it'll actually make a difference. So if we get big and then, like we get other RIAs and investment advisor and investors to do this, and we change the whole world, you know, and not by the government, by making the business leaders that have all the money do what we ask them to do, or you're fired. Right? And we can make the corporation turn off the faucets to the politicians, not with laws from corrupt politicians, but because we told the corporations they're not doing that anymore. Right? That's cool, right? You own them in your retirement, all this stuff is powerful. And so that, you know, in my opinion, kind of doubles your impact. So access to capital, rewarding people that are doing good things, removing capital from the marketplace. And they've tied a lot of these executives incentives to short to intermediate term stock prices. If people are kind of pulling their funds, then it's going to be hard for them to hit their targets. They're not going to get paid near as much. And so they're going to want to do the right thing. Maybe not for the reasons you and I would do it, but still, you know, we held the carrot out there for them and they'll follow it. So I believe that individual ownership will create that direct line between your values and the impact that you want. Okay. And not just a good marketing story. Okay. And so you'll be able to see it. It'll be a little bit harder because right now the marketing thing goes both ways. If you have like 10 funds in your portfolio and all of them, you know, say something about carbon free or environmentalism or, you know, diversity and inclusion, and you're just like, wow, I'm doing good. I could see it. There's only 10 funds in here. Now you're going to have like 200 and some companies. And you're just like, is this really like doing good or whatever? It can be hard because there's going to be more noise in there. But one of the things I'll show you is we give you good reporting for that. And you can understand what you're doing. So how we construct, we do a values assessment. And so, like, again, I put some of those links in there. Should have been clicking through more. Like, you can check us out as a B Corp if you're interested. One of the things that we're going to talk, oh, wait, I'm skipping ahead. I have a slide for that. Who cares? These are called SDGs. They're the sustainable development goals. They're from the UN. They made them a long time ago. And it just talks about all these different things, like, and breaks it down, you know, very granularly. And each one has sub things that are inside of it, you know, that you're probably on board for some or many or all of these things. And this gives us some kind of standardization of how to look at things and categorize, et cetera. And one of the main people that we partnered up with, this Ethos ESG, is how we do the questionnaires. And it does kind of, when we're looking at, you know, when someone takes an assessment for us, all these different SDGs and some of the sub ones inside of here, and helping us quantify which ones are more important to different people, right? So that we can focus on those things. And when we do that, then say we break down, like this is like health and well-being, you know, and they get graded on here, and you can kind of see who's got the highest. This is just ranking kind of the top 10 or 11 here. And then our clients have access to this, but like showing you like where are these scores coming from, how do they find them, et cetera. And we have this for large and medium and small and international companies. And then, but there's different things, like we said, like there's the health and well-being and climate action, innovation, peace and justice, sustainable resource use. There's more, but you could see like it's different companies for different ones. And once we find the mix for different people, we have access to other data that we use to find who do we think are the best companies. Then we combine it with the values based. We can do the same thing with a law, with like Sharia law and our partnerships that we have there for their research and certification and we combine these things together and then build great portfolios that have a certain amount of large companies and medium and small and international and value and growth. And then we buy low and sell high, plus redo the screening, plus like as you were seeing here, like for our sample client here, people could have multiple versions over time of how they may have evolved. And we can even see how portfolios have changed over time to get, this is more of an aggregate, and we can look at like, oh, how is the actual portfolios grade? So this is more of a portfolio that was more of an ETF. So 77 score on an ETF ESG is actually pretty decent. But with a lot of our Plank portfolios now, we can actually, I think, improve the efficiency, reduce the cost, and get it up into a solid A by having the individual security selection plus have the voting. And so basically, when we're talking about this, doing that values assessment, figuring out what people want, then combining that data along with our own due diligence of just making sure that they're good companies, that they're doing well financially and going to grow, for their category against their peers and the different metrics that we use, and then strategically weighting them so that we reduce risk for you not to have too few eggs in your basket or too much in one of those eggs. And then we monitor over time to rebalance. So if something's doing great, we want to take money off the table. If something's a good company, but it's down, we'll buy some more of it. If somebody's become a bad actor that was good, and it's not an impact type portfolio, then we're going to screen them out and find someone to replace them. And then we're going to report to you, because I think it's important to have not only performance reporting that you did well and you made money, but that there is accountability that we're following through with empowering you, that we actually were good stewards of helping you invest how you wanted to. So we talked about the SDGs. You can look this up. You just Google it and you'll find their website. And if you want to look through it more, kind of like how I was showing you here, then you can click into it and drill down and it'll talk about it, and they have reports and you can see the sub things that are inside of there. It makes you feel better about the world, that there's lots of people out there, not even just one nation, working together and thinking together about solutions to make the world a better place. And this is not a new thing either. This right here, this little demo, I've been showing you kind of the sub things from Ethos, which is one of our partners. I'm going to give you, and if you have our thing here where you're calling along, when you get down to the end, you have these links. You can click on them as well if you want to use any of our tools yourself. And so, if you do that impact assessment, you'll click on this and it'll start pulling you into what's most important to you. And then as you pick these things, then it'll come into sub questions so they can drill down into the sub things that are important to you. And that's, I think we were breaking it down so far, like into like 47 different, things. And that this is more for the ESG beyond like religious values. Eventually I want to get to where I can combine, religious and ESG together so that it's even more customized and unique as well. But you could take this. It doesn't cost you anything. I think you do give us your information. We might follow up with you to say, hey, do you want to talk to somebody about your results, or are you fine with it? Just having the report, it's up to you. But it's pretty cool. We actually use this when we build portfolios, but if you just want to report on how you feel, you can use it as well too. If you want an investment, like portfolio analysis, this is whether you're values based or whether it's just investment wise, because with our Plank portfolios, even the traditional ones now, I think we got the cost down. It's between 0.02 to 0.1%. And we can do it for as low as like, I think almost $15,000 for aggressive portfolios. It's a little bit more the more conservative you go, just because we have less money that can put more in like the bonds and the conservative part of the portfolio. So we have less money to split up between the 240 or so stocks that we got to put in there. But if you do this, you schedule an appointment. And Franco, he's not a sales guy. He's not even an advisor. He is my investment guy. So when you meet with him, it's a shorter thing where he just explains to you the analysis. We're just trying to help people understand. And if they want to work with us or they're interested in like, well, it sounds like that this might be good, he would actually help you schedule with an advisor if you want. If not, just take what he gives you and run with it. So you schedule that. Then you're going to submit your portfolio. There's two ways to do it. We got a secure way that you could upload a file if you had it with Robinhood or Merrill Lynch or whoever. There's also a thing in the questionnaire thing. It's run by a company called Nitrogen that you could hook it, that one account via Plaid. And then from that, we get a risk tolerance from you, which is like this thing. It helps us figure out objectively. It's not perfect, but it's real fast. It takes just a couple, 3 minutes. Helps us figure out objectively how aggressive or conservative you are. Because there's just tons of people that'll say, well, I'm really conservative. And I'm like, are you conservative like based on your beliefs in this? Are you conservative like you don't really want any risk in your investments and you don't care that you're not going to grow very much? Like, oh no, I don't care if my investments fluctuate. I want to grow a lot. And I'm like, well, you're not conservative to us. Right. So we need that objective thing. So it's like once we have that combined with how you're invested now, that helps us do the analysis. If you want to combine everything together, then you would do boom, the values based plus the portfolio analysis. Actually, we built this for people that become clients with us and they say they want to do like the plank, like ESG or what's so, then it's like, all right, you got to take the assessment. Generally in the onboarding there, you took the risk assessment. And then this is a very important thing for us because we want most of our clients to tell us how they really believe. And if you're one of those people that say, you know, I really believe strongly in this, but I don't want to invest very much that way. I'm afraid that if I don't grow, I'm already behind saving for my retirement, that it could really hurt me or my goals or objectives. My health's not the best as it was. So I don't have a few extra years. And if you do good for me, then I'll just tithe more or give more, right? That's what this bar is for. Okay. And you can put it anywhere you want to. Okay. So you could say, you know what? I'm hardcore to my values. If my, we call it tracking error. If my rate of return varies widely from the S&P 500, doesn't mean you're going to do less. Doesn't mean you're going to do more either. It just means that it could be different than how the regular markets are going. Then you can slam values based, right? Now, if you say, hey, you know, I really do believe in my values, and I want you to weight it, but only like 25%, right? You get to pick, right? On side of here. So most people probably, if you're watching this and your values base, are going to be probably between, 50 to 100, 90 doesn't, even 85 to 90 doesn't have too much tracking error. You start pushing more, that's when we made the color change, things change there on the warning type thing. So I don't think it's bad. We just want people to know that you kind of push this way. You're kind of saying, hey, I don't care if I underperform a little bit. I don't necessarily think you will, but you got to have that in your mind if you're going to push it this hard. Okay. So I think most people should probably be, even if you believe in it a lot, you want it to pretty much go with the markets, something like that. But it's up to you. You get to choose. And if you need your advisor to help you with this or coach, they absolutely can. Most of our clients have that. We have a freemium version where you can join us without a coach or advisor because that's my most expensive thing here to pay for. We're building another one of the fintech things is kind of like an AI type thing to help our freemium clients make better decisions and stuff too. The hard thing is the SEC is a hard regulator and we got to work on making it better. And we'd like a little bit more guidance on, are you going to hardcore on our AI just like you are on a financial advisor? If so, it's not just education and information, then it would be difficult for us to do for free. But anyways, if they like say, hey, if you got these disclosures, then, and it does a pretty good job, but we're just saying, hey, it's for information and education only, then people need to do extra due diligence or kind of upgrade to get an advisor, then we could release something earlier. Our goal is to help people. But again, I can't go even though I'm not a profit maximizer, I can't go negative. You won't have a business very long. You'll go out of business. So anyhow, I hope this gives you a little bit of an idea of what we're doing and how we're helping people. I know it doesn't give you total transparency into exactly what stocks are in there and this and that. That's a little bit beyond this. I'm going to have Franco probably do some more, but there'll be advanced webinars in terms of giving demos on the actual plank and a little bit of what's in there and how we do the due diligence and how things are selected. But even for some of our more competent, educated in the field people, it goes over the head a little bit. Me and him primarily have been building these together, but we're not against the transparency. And for those of you that are a little bit more sophisticated and understanding how we do that. So again, you care, we absolutely care. I believe it's our kind of steward, important mission to empower other people, and we keep making better and better things. So we are trying to walk our walk. So again, if there's any questions, put them in here. I think we got a couple of minutes. I could probably answer a couple if you have them in there. You can schedule a complimentary consultation if you want to. So our first appointments are always free just to see if it's a good fit. And even if it's not, they'll explain to you the freemium, and you could start that yourself and use all of our kind of DIY tools until maybe at some future point you needed help. This is that ESG ethos questionnaire, and this is that portfolio analysis page. So you can either QR scan it or click it if you've got the online version like here, and it'll take you right there. So let's see if there's any questions. If not, I'll give you a couple minutes of your day back. So throw it in there if you got one. All right. Looks like I got them all in the middle. I want to thank you again for joining us. Let's see. What's our next one, Aaron?
It's laissez-faire, succeeding in a capitalist world.
Yep. So we talked about that a little bit in this one. We got the laissez-faire coming up. Bear with us if you signed up for. I think we may be changing from Webinar Jam just because I've gotten multiple kind of feedback from our audience that the resolution's not high enough. We put it in multiple times. So we may either go to Vimeo or another one of these that'll get us higher resolution. But we'll get you in there if you signed up. And so check out the how to succeed in this, because I want you to be successful. And I really believe, and like I said, kind of the B Corp thing or the conscientious capitalism is like we can succeed together without having to screw people over, right? And that's what we're going to talk about. And even like where Jade was asking us the business question, right? We can work for other people, we can start our own businesses, we can do both, and we can succeed together. And then we're going to go into another crypto session on October 8th. So thanks again for joining us. Appreciate you spending a little bit of your time with us. You're welcome, Tasha. It's good to see you again. And let us know if there's anything we can do to help. Hope we see you in the future. And thanks so much, and have a great rest of the week and day. See you next time.